Everyone loves a tax-free promise, but do you actually know which accounts deliver and which ones quietly hand you a bill you never saw coming? Today we are cracking open one of the most misunderstood comparisons in personal finance. And the stakes are real, because the wrong move could cost your heirs tens of thousands of dollars they never expected to lose. Let's start with whole life insurance loans, because this is where most people get confidently wrong answers at dinner parties. When you borrow against your whole life policy's cash value, the IRS does not consider that a distribution, which means no taxable event, no forms, no awkward conversations with your accountant. The catch, and there always is one, is that if your policy lapses or you surrender it while a loan is outstanding, suddenly every dollar of gain above your basis becomes ordinary income in the year it collapses. Think of it like a financial time bomb disguised as a safety net, sitting quietly until the wrong moment detonates it. Withdrawals from whole life are a slightly different animal than loans, and the distinction matters enormously. Up to your cost basis, meaning the total premiums you have paid in, withdrawals come out completely tax-free. But every dollar above that threshold gets taxed as ordinary income, not the friendlier capital gains rate. Now, contrast that with a Roth IRA, which is the golden child of the tax conversation for a reason. Contributions come out first and always tax-free. And once you hit 59 and a half and have held the account 5 years, every single dollar of growth rides out the door without the IRS touching it. Traditional IRAs, on the other hand, operate on borrowed time because every distribution is fully taxable as ordinary income, and required minimum distributions starting at age 73 mean the government eventually forces you to trigger that tax whether you want to or not. It is essentially a partnership with the IRS where they silently own a percentage of your account and get to name their payout schedule. Taxable brokerage accounts bring their own flavor of complexity, taxing dividends and interest annually as you go, and then hitting realized gains at either short or long-term capital gains rates when you sell. The irony is that a taxable account, despite its ominous name, can actually produce lower tax rates on gains than a traditional IRA if you hold assets long enough for preferential capital gains treatment. Now, here is where whole life gets genuinely interesting for your heirs, because the death benefit passes to beneficiaries completely income tax-free, regardless of how large it has grown. That is a clean, contractual transfer of wealth that neither a Roth nor a taxable account can fully replicate in the same structural way, though Roth comes impressively close. Roth IRAs inherited by non-spouse beneficiaries must now be fully distributed within 10 years under the Secure 2.0 Act, which, while still tax-free, removes the decades of continued compounding that made inherited Roths legendary. The stretch IRA strategy that let beneficiaries take tiny distributions over their lifetime is largely gone, and that changes the calculus for estate planning significantly. Traditional IRA beneficiaries face the same 10-year rule, but with the brutal addition of paying ordinary income tax on every dollar they pull out, which can push heirs into higher brackets precisely when they are least prepared for it. Imagine inheriting $500,000 from a parent's IRA and quietly discovering that your effective tax rate on those distributions could be 32 or 37%. Taxable accounts, surprisingly, offer one of the most overlooked gifts in the tax code through the stepped-up cost basis at death, which resets the asset's basis to its fair market value on the date of death, erasing a lifetime of capital gains. Your heirs could sell immediately and owe nothing, which makes a well-managed taxable account a surprisingly elegant estate planning tool hiding in plain sight. Historically, tax policy has shifted every decade or two, and what looks optimal today under current law may look very different after the next major tax reform debate in Washington. The smart move is to build a diversified tax bucket strategy, holding assets across Roth, traditional, whole life, and taxable accounts. So you have flexibility to draw from whichever bucket is most advantageous based on your tax situation in any given year. The biggest misconception people carry is that whole life is either a scam or a magic bullet, when the truth is, it is a specialized tool that works best as a complement to, not a replacement for, traditional retirement accounts. The policy loan feature is powerful precisely because it is not a taxable event, but only if you manage the policy with discipline and never let it lapse under a loan balance. Discipline and sizing matter more than any single tax strategy, Because the investor who consistently funds multiple account types, rebalances without emotion, and avoids unnecessary policy surrenders will outperform the person chasing the perfect vehicle every single time. Comfort with any outcome comes from knowing your plan accounts for multiple tax environments, not from betting everything on today's rules staying permanent. At the end of the day, tax efficiency is not about finding one magic account, but about building a coordinated system where every dollar has a job and every withdrawal has a plan. And if you want help building that foundation through real estate investing, home contracting, or finding the right lenders, check out our links in the description below.